There's no easy way to fix these power outages, and it seems like they strike every 7 years, whether it's, a hurricane, excessive heat, or one of these fronts moving through an area that's not normally exposed to it. If you look at crude oil futures, though, it is at a 13-month high. Same thing with gasoline. Just on the day move, though, we've got a 5% move higher on natural gas and also gasoline. So those are a little bit late to the party here. We don't anticipate that natural gas futures will continue to extend any kind of rally. You might see some short-term squeeze on the front month. And then if you push to crude oil, Texas is probably going to lose about 1 million barrels per day, especially with the shutdown of that channel near Houston. If you break down into the numbers and you really get into just the specific numbers of it, crude oil, we've got about 469 million barrels in inventory. The 5-year average is 461. So we're getting more aligned with where we've normally at on a historical level. You break down gasoline, 256 million barrels versus 257. So it's a little bit tighter, and that's because of the reopening that's been happening with the vaccine rollout. People are starting to get a bit more mobile. If you break down Cushing, we're in line with 48 versus 48 on the 5-year versus this year. In natural gas, we are right in line with where we were at last year with 2,518 billion cubic feet in storage.
Phil, it's Julie here. It's good to see you. I want to ask about gasoline specifically here, because I know a lot of the refineries are temporarily shut as well. So what then are the knock-on effects of gasoline, not just for trading, but I'm curious on the retail level, if there's going to be an increase in prices as well as a result of all this?
Prices have been increasing for quite a while. And I mean, if you look over the last quarter, gasoline prices are up about 53%. Crude oil futures and crude oil ETFs, they're up about 48%. So this has been the inflation play that's been taken away ever since rates started rising and inflation started, coming into the market. It hasn't just been gasoline and crude oil. It's been other commodities, everything from lumber to soybeans to agricultural products. So the energy sector is where once people we get the reopening, they're able to travel and they start, driving around and things. This is where those lower income bracket people are really going to feel it hard, especially in their wallet, because they're going to realize that crude oil prices, gasoline prices have basically doubled since the pandemic. And as well as at the grocery store, their grocery bills are going to continue to increase as well.
Phil, I don't want to get too philosophical on this one, but do you think asset and commodities markets should be pricing in really, I would say, a permanent climate change premium? Look what we have dealt with in California the past year. You're seeing the inclement weather on Texas, like we have been talking about here. Should this be better factored into commodities prices?
Well, I think it is. I mean, if you look at, some of the solar ETFs, those were one of the best performers at the start of the year. There was a big shift into, silver and platinum, rhodium, things that are going into catalytic converters. Those prices were already taken off. If you look at Texas's breakdown on energies, it's pretty evenly split between everything from, your wind, your solar, nuclear, your fossil fuels. They're all evenly split there. So they do have a diversified energy capacity, but it's just that when you get these areas that are not normally exposed to it, you start to see, this crippling effect happen, just like as if, it's no different than a hurricane coming through without the all-out destruction that we normally see.
Phil, looking more short-term also, I want to talk a little bit more in detail about what's going on with oil prices, right? And this push-up that we have seen. As you talked about this perception that if inflation is coming, this is one of the places it's going to be seen. I also am curious, as we talk more about reopening, how much is crude oil discounted right now because of the lack of jet fuel demand specifically in that market? And then how much more upside is there potentially before the end of the year if we get a return to normal or even 75% of normal for plane travel?
So from an equity investor standpoint, I still believe that like travel, leisure, cruise ships, airlines, those are all going to be your best plays right now. Those are the areas that when you pull up the chart on any kind of, individual basket of stock, anything looking at any of the blue chips or anything, it seems like all these equities are at all-time highs, and you find little spots where you could actually find valuation. And there's still large short interest in many of these airline stocks, travel, leisure. So I think that's where you've got to be positioned at. From a commodities standpoint, I still think that gasoline, crude oil are going to continue to ramp higher at an accelerating rate. I think crude oil realistically could hit, $72 to $75. And I mean, it's still quite a big move. Remember, OPEC's really been in control ever since the Biden administration. It seemed like the U.S. kind of tempered back on how we were going to control oil prices. And it seems like OPEC's playing more of an active role, right or wrong, on things. OPEC has done a great job helping support prices to promote some of their economies and things. They've taken off 130 million barrels of crude oil in excess supply since last June. So we are getting more right as far as supply, demand, and the structure. Prices are going to gradually rise, but it's these short-term impacts that really have these explosive moves higher and impact, the individual consumer.
And, Phil, finally, before we let you go, there's been a lot of talk about commodity super cycle the last couple of days. And as you've outlined, I mean, this has been happening, go down the line. Almost every commodity has been up in price. So maybe a little late to the game to call it now. But how have you guys been thinking about that dynamic at Blue Line? And where do you think that, this kind of goes over the next couple of years as hopefully most of the world gets back to something like normal?
So we're really model based on, and we evaluate all asset classes, sector styles, and we monitor, down to specific things like the 10-year note. And the bottom in commodities was when the 10-year futures, really double bottomed at that 0.4%. And we've been anticipating this breakthrough, the upside on the 10-year note. And what you're seeing now is that there's a rush into different asset classes because inflation is taking away. CPI will print over 3%, coming into the first and second quarter. That's where we're going to peak out. And that's where the rate of change on economic data will start to compress. So the back half of the year looks a little bit grimmer than this first half. This first half, the commodity super cycle is definitely underway. The back half, small compression because there's going to be less rate of change, less job growth, less things like that. People are not going to come back as fast in the second half. Anyone who wanted a job will have gotten a job. Any business that wanted to reopen will most likely have reopened.